Good evening, ladies and gentlemen. First of all, a big thanks to all of you to have come in the evening. I see some very familiar faces here. So it's been, the traffic notwithstanding, I see a full house, and thank you for that. Thanks also to HDFC who have this wonderful series, knowledge series that they come up with every year. And this year we have it on pre-credit and cybersecurity. I'll try to make it as concise as possible so that we can have some time for some Q&A. I'm sure a lot of you will be looking at some interactions post this presentation. Without further ado, I think I'll just dive straight into the presentation. A bit about the economy. Well, basically, we've got various forecasts. IMF, World Bank, they're all talking about 7.2, 7.3, 7.4. It doesn't matter really. What we know is it is a reform-led government. Well, yeah, I mean, reform-led indeed, but then we've got some growth outlook slightly diminished this year because of the two major events, demonetization and GST. Yet, India's economic outlook remains very promising in Asia. In fact, today in the papers I read Moody's upgrading our sovereign rating from BAA to BA3 and basically the outlook from stable to positive. In 14 years is the first time that upgrade has happened, so I think they've done a big leg up to the Modi government, so I think that's a good thing. Yeah, as I said, it's a reform-led government. So basically restoring credit discipline, I think that's also played a big part in Moody's upgrade today. That basically the credit discipline and cleaning up the bank balance sheets and basically to help in credit growth. Clearly low inflation has been obviously a tighter monetary policy has helped a great deal. Again, although the government has promised a lot of job creation, now we're seeing government getting into infrastructure in a big way, whether it's power or highways or roadways. Well, it remains to be seen. We're talking about a hyperloop from Bombay to New Bombay today in the papers. We've still got to figure out how to get on the rail. But still, it is a heavy investment in infrastructure. Hopefully, that will create more jobs and lead to a greater capital formation. Clearly, having said all that, there still is a lot of road ahead of us. We still have major structural deficiencies that we need to understand. We have an underdeveloped agricultural sector. We have a rather poor infrastructure. Inflated and not too flexible labor laws. Pretty much excessive bureaucracy. You still have problem in land acquisition, land laws, and of course skilled labor. In fact, today's newspaper about Bill Gates talking about the educational sector being the biggest worry of us. In fact, was probably disappointment, he said, which is something that we should look at, because education and healthcare are two sectors that we really need to really step up. Now, in Atradius, we offer credit insurance. Clearly, we'll talk more about the company later. Besides that, we also publish a lot of reports. We do a lot of research about countries, sectors, risk, etc., etc. So one of the things we do is publish a country performance outlook. Now, in our estimate, if you see this weather chart, not too sure whether you can see it clearly. Are you able to see this? Small little, not really. Okay. So we've got these four weather climatic patterns. One is the sunny day, that really means excellent outlook. We got a partly sunny day, which is basically a good outlook. Then we got a cloudy day, well, not so, but it's a fair outlook. And we've got a rainy day, which is a poor outlook. And of course, thunder and lightning, which means it's pretty bleak. So if you see across the sector, I don't know. Yes, somehow. Basically, I'll just tell you, most of the sectors, surprisingly, well, not surprisingly, they are in the fair to good economic outlook. The sectors that are not in that category are basically construction materials, steel, and metals. So other than these 3 or 4 major sectors, most of them, automobiles, food processing, consumer durables, agriculture, all of that are in the fair to good outlook. So as a risk, it doesn't help us too much because India as a risk is a good risk. So you'd be surprised. It's much better than Russia or China. So India as an outlook is a good country risk as far as we are concerned. So basically, this is how Atradius looks at countries, and we publish these reports across. So that's something about the economy. Well, that's what it's all about, isn't it? You got last year demonetization, you got GST, you got all kinds of upheaval. We got two guys trying to nuke each other. I don't know. When Donald J. Trump and Kim Jong-un is having a nice little party there. Italy doesn't qualify for the World Cup. I know lots of things are happening. So there's a lot of unexpected events that are happening. So we need to be prepared. We're in an increasingly volatile and uncertain environment. What if your trade sector suddenly slows down? What if your biggest clients go bust? What if your buyer suddenly decides to close shop without paying you? What if fraud prevents your buyer from paying you? So these are all just a sample of risks that one can talk about. Now just consider a small example. Let's say I'm an SME industry and I'm working on a 5% margin. And I suffer a 100,000 rupee loss, a lakh rupees. Now I need to generate sales of almost 20 lakh rupees to make good that loss. Okay? So we don't realize that the one asset in the balance sheet that has absolutely no safeguard from catastrophic loss is accounts receivable. There's zero. So basically, this example gives you the kind of extent an SME would face just 100,000 rupees loss for a 5% margin. And that's pretty much the story of most SMEs. So this is the kind of extra sales he has to generate to make good that loss. So what do? Here's where we come in. So basically what we do is provide cover for buyers that don't pay on time. So if you look at this triangle, it's called the credit insurance triangle. I'll discuss a bit later in detail on this. So what are we talking about? We're talking about the customer who's a policyholder who basically delivers goods and services in terms of to the buyer. And let's say the buyer does not pay his as per the contract. It's a default of his bill. So what we do is offer the customer, that is the policyholder, credit insurance. I'm sure a lot of people know that, but I'm just trying to reiterate this. Offer credit insurance against the default of this buyer. In the domestic market, it's protracted default, and in the export market, protracted default and insolvency. And the export market is also a political risk. So if you're looking at a buyer defaulting to a policyholder, we will then pitch in and mitigate that loss and indemnify the customer up to a certain percentage. In India today, the IRDAI allows 85% indemnity for any default of the customer under a TCI policy. Now to do that, what do? So there are two kinds of things we do. We actually underwrite limits for the buyer, against the buyer. So basically, we look at the buyer and actually set a limit that the policyholder or the customer can actually trade with him. Of course, he can trade a little more, but we are liable to the extent that we assess the buyer and set a limit. Now, how do we do that? There are two kinds of, let's say, players in the market. One are limit underwriters like ourselves. We're called full-service underwriters. And there's the other category called discretionary underwriters. So people like ourselves are full-service, which basically means we've got large credit analysts. We've got a number of underwriters actually underwriting buyers at an individual level. We talk about, we have a large bandwidth and a large team to go into underwriting each buyer. However, the discretionary underwriters actually underwrite more the credit management process of the policyholder, which means that if they're broadly satisfied with the credit management process, they will then underwrite that policy based on a larger discretionary limit. And typically in these policies, the discretionary limits that discretionary underwriters give is large, and also, of course, the deductible will also be large. We, on the other hand, actually then go and underwrite limits, and we actually don't give that kind of discretionary limits, and also not that kind of deductible. So it's actually beneficial for customers to take a full service underwriting because A, the risk transfer is not just happening. We're actually helping the customer foresee risk. Okay, we're not just into the business of paying claims or pricing it at a very moderate rate. We're actually in the business of mitigating loss and foreseeing future risk. So in order to do that, we have, as I said, a fairly large team of underwriters, of special risk managers, of claims managers. So that's how we actually underwrite limits. Now, obviously, if there is a claim, it's obviously paid to the extent of 85%, and this, by the way, can also be assigned to the bank. So this is basically how we operate. In India, we're based in Bombay, and we're present, of course, all over the world. Now, Ritesh mentioned things about the digital space. I think we're not, traditionally, credit insurance is a 90-year-old industry, and we're not that on the forefront of technology. But now we've embraced digitalization in a fairly big way, although it'll come to it'll basically roll out soon. What we're trying to do is basically using machine learning, artificial intelligence, and big data to look at processes that can seamlessly underwrite risk. Today we are looking at very structured information based on which we underwrite risk. Now, as the world is so uncertain, we are faced with all kinds of data, okay, in the net and unstructured formats, and we need decisions real time. So that's why we are working very hard in our offices across the world to have a big push in especially things like predictive modeling and getting to understand risk much better. As I said, factors that it's way beyond human capabilities, so we have to use machine learning for that. So all that is exciting, and it's happening. So we'll be soon in a position to do almost real-time underwriting, almost real-time pricing. So these are things that are trends that are happening. So I just thought I'd mention that, given that risk, HDFC ERGO was also at the forefront of having a digital push. Basically, if you see, in today's fiercely competitive market, the pressure to meet buyer payment terms is greater than ever before. Increasing number of suppliers agreeing to open terms. That's the only way to seal the deal. Open account term is more agile, of course, and the other forms of security are pretty expensive. LC is expensive, guarantees, all it's expensive things. So why not look at open terms with a TCI cover? So this is seen, you'd be surprised, there are certain companies that were not ever insured because they were traditionally thought that you'll never ever get credit. But they're also coming to the market with open account offers. How does it help you? Basically, if you know, in most companies, 80% of your business comes from 20% of your customers. Now, as I said, this product, no other product basically helps you to mitigate a catastrophic loss in your accounts receivable. You just have those safeguards. Whereas this, what if one of your customers just don't pay up and probably gets insolvent? That's one big thing that's we coming in. Then, of course, you can actually improve your income. You're managing your bad debt reserve and write off something with greater certainty. That can bring back reserves into your income. Of course, needless to say, you don't have bad debts flowing around. Your cash flows vastly improve, and your DSOs improve quite considerably. And last but not least, this is actually the interesting part. We actually can sell more. So we don't sell this product as a loss mitigation tool. We don't sell it as in case the buyer doesn't pay. Of course, that's part of the deal. But what happens is that we've seen, and I've seen it personally, that customers and policyholders have reached into new markets. They have increased sales considerably, than where they were before taking a credit insurance product. And they've increased sales to different geographies. Because they can actually go and sell to customers because their core business is manufacturing and selling and not credit management. And we have this huge, massive database. We've got ties with agencies. So we know a lot of customers in the market. So we're able to give them proper credit advisory and limits based on which they can actually go there and increase their sales. So basically, as I said, it assists companies to enter into new markets, enables to basically get more goods and services on longer credit terms. But beyond all this, I think, as I said, mentioned earlier, what it does is that our primary job is not playing claims, but essentially to help customers foresee, probable risks, because we are in the business of understanding risk. And if there is a customer out there in the market that's not paying up, or we know exactly what's going on, we will then tell that customer. Please remember, there is a certain amount of self-insurance involved in all customers. In India, it's 15%. So we do that job for that. Now, all of you are obviously in the banking profession, the NBFCs. Now, clearly I'll come to the IRDAI a bit later, but this mechanism, I think after the global financial crisis, I think all of you are aware that clearly in Basel I, Basel II, and Basel III, the increased stress was on how your quality of risk is, and to not get down that slide. So I think credit insurance-backed trade finance, that's really been the increasing trend across the world. I think it's a win-win situation because the bank is basically selling on the back of the insurance cover, and therefore the risk quality considerably goes up. And this really is the key thing. So I think it's basically to create awareness and of availability of risk transfer. Trade credit insurance helps to do that. There's obviously leniency in requirement of security. Obviously, if you have a TCI cover, you won't be subject to that kind of stringent guidelines. You obviously will get a lot of leverage. Encourage and promote insuring as a balance sheet protector. Basically, you can leverage trade credit insurance to get a very good deal from the bank at probably a far lower cost than you probably go to any other sort of financing. So TCI is basically not just, as I said, a loss mitigation tool. It helps you free up your balance sheet, it helps you free up your reserves. It is a low cost and obviously gives you additional chances of increasing your market share. So actually it's a very good product. So we've been here for a while, and we're kind of surprised why our market share is total market size. I can't even go near the numbers Ritesh was talking about. He was talking in millions. I can't even go down that road, but I think essentially what I'm saying is it is a very bespoke product. And it is a product that basically a corporate and SME increasingly are taking, but they will obviously continue to take, and we see good growth potential there. Well, as I said, Atradius is also into the business. Well, they don't just provide credit insurance. We do a lot of research, we do a lot of papers, we publish reports. And this is an interesting slide on, we publish something called the Payment Practice Barometer, which basically we do on a countrywide basis, and this is for India. I think this is as of June 2017. Basically, if you see the total sales, 44% is on credit, on open terms. Are you able to see this? Yeah, okay. So 44% is basically on open terms. We note that in India, almost 47%, they pay on time. They're okay. But 53% are basically past due. They're all overdue. And out of that, the uncollectible is the red worm that's going there. It's actually hovering always between 2.5 and 3. 3% of your total receivable is actually uncollectible. So this is an interesting trend. So last year it was 45, and this year it's 44. So roughly, basically 45% of our total business is on credit. Now, interestingly, if you see this, 21% of suppliers in India said that due to payment delays, they needed to take additional measures to correct their cash flow. Now, 38.1% of respondents in India plan to do more to protect their business against the impact of, Brexit and US protectionism. B2B customers in the consumer durables industry generated one of the longest payment delays. So these are interesting insights where you know that, well, there is money that's just not collectible. They're just not past use. And increasingly, personally, we've also noticed in the last couple of years that payment delays have happened from industries and sectors that we thought wouldn't delay. And also we had losses from sectors and companies that were in business for more than 30 years and had actually gone bust in India. So it's, although allegedly a low-risk country, but we're increasingly seeing the trend of overdues, of bad debts, and of actually, with the new bankruptcy laws, I think that will come even more. A little about our company. We are basically integrated credit insurer. We've got more than 160 offices in 50 countries. We've got about 3,700 employees across the world. They're basically bespoke, as I said, and tailor-made. We've been there since it was a Dutch company. It's a long history of trade credit. We've got an annual revenue of about $1.8 billion. Financial ratings is AM Best, A Excellent, and Moody's is A3 out of the stable. Well, access to information of 240 million companies. This is why I was still referring to, things like big data and artificial intelligence, because the data we deal with is large. Okay, we have lots and lots of data. So I think this is where digitalization will greatly help in understanding the data much better. We're based in Amsterdam, of course. We are now part of the CYC Catalana Occidente. Catalana is not a scary word, but we're still part of a group of Catalana. So we're not affected by what's happening in Spain, I can assure you that. So basically, that's the largest insurance company in Spain. So so basically now, as I said, I will make my presentation quite short and concise, but I thought I could give time for interaction. A bit about the IRDAI. Now, I'm sure a lot of you here sitting would know what happened in 2010. And in case not, I'll tell you a small story here. We had IRDAI giving us a guideline in 2010 that basically revised the entire way we conduct business. Now, as I said, some of you do know this story. We had an airline company called Paramount Airways. It's a Madurai-based carrier, and they were to regional carrier. Now, of course, what happened there is that they defaulted in their lease payments to their parent, to their aircraft supplier. I think it was Embraer. And Embraer decided to basically enforce that, and 3 of the aircraft were grounded. Now, of course, if 3 of your aircraft of a possible 5 get grounded, then DGCA steps in and pulls out your license. So basically, they had no license to operate because, as an aviation operator, you need minimum 5 aircraft. So then, basically, they were obviously depending on banks for all of their needs, including their day-to-day needs and their aviation fuel needs. And once that license is pulled out, they owed banks roughly to the tune of $90 million. Now, the banks in turn were insured against default of Paramount Airways with a large PSU insurer. They're taking out multiple policies across India. The problem was that the insurer did not have a reinsurance arrangement. Okay? And they themselves did not know the quantum of exposure on this particular entity called Paramount Airways. So you can imagine, you had policies all over the country, and you had a combined liability of $90 million US. And nobody knew actually what the exposure was, including the insurance company. And then given that they didn't have reinsurance support, it just fell apart. The IRDAI basically came out and gave a guideline that, well, all credit insurance is stopped forthwith. I still remember the date, it's 2nd of November, one day before the Bali. And I was just 3 months on my job, and basically I get a note saying that basically you can't do any business. So I was like, what's going on here? So, and after that, we were in limbo for 2 months, not knowing whether to even the existing policies could be done or not. And I think in the 13th of December the same year, 2010, the regulator came out with a guideline for trade credit insurance. The first guideline was no credit insurance to banks, factoring companies, NBFCs, etc., etc. And majority of our business were from banks, factoring companies, and NBFCs. Or we'll have very large clients who's assigning the policy to a bank. So we're staring at almost 70% of our book just disappearing because of that guideline. So we're trying to figure out what to do. So the only saving grace was that the guideline said that the existing policyholders can actually continue, and only if you're getting new policies that you have to actually go to the insurer for filing and of course permission. So in that respect, we managed to renew most of our business, but then the big issue was how to get new business. So now we had to change strategy completely. So some of the points that was there that we can't obviously issue, the underlying transaction has to be trade and risk. It basically has to be a trade credit transaction. It cannot be a financing transaction. It has to have a buyer and a seller for goods that have been supplied and for a consideration. They reduced the minimum indemnity to 80%. Earlier it was 90%. As I said, it can't be issued to. There's a lot of other caveats too. You can't do single risk cover. You can't basically. There's a lot of other caveats. But the main ones are the fact that, and there was a whole turnover policy. Basically, it also said you have to have a minimum of 10 buyers. So that also put a lot of restrictions on, let's say, an SME who's got, let's say, 5 buyers. So he's without a cover. So this actually affected the entire spectrum. So it had a far-reaching implication, this guideline. So effectively, it just removed the entire invoice discounting, factoring, and bill discounting and NBFCs into doing almost to almost zero. So because they were doing it on the back of insurance company. So that's been far-reaching effects. So what we had to do is completely realign the way we do business. So we had to then do whole turnover for people who actually need, loss mitigation. So we've been lobbying so see, it's not about just the fact that there's a guideline. I think the fundamental point here is that I wouldn't say attack, but yeah, it isn't. The product was what was touched, but not the risk, underlying risk. In this particular transaction, the product has nothing to do with it. In fact, we're just doing the opposite. We're actually doing due diligence on the buyer. You're doing due diligence on a buyer level. Whereas in the Paramount case, there was absolutely no due diligence done on buyers. So we're doing exactly the opposite. We're actually doing due diligence on everything. So that's why we're surprised. So I think that we've been going to the regulator with our representations post that period, because the product is an excellent product. It's the underlying risk which caused this problem. And that was purely because they didn't do their due diligence. Okay, so all of us were still recovering from that, but then life goes on. I think we've done pretty well in the last 5 years. And actually, in fact, we've been very robust growth because SMEs still need this. And we've been focusing on that. Of late, I think there was a revised guideline in 2016. There was a brief period where we actually opened the champagne bottle, and because there was a guideline before the guideline saying, a draft guideline saying that everything is open now, including factoring and bank policies. So basically, that didn't happen. It was a slightly better version of the old one. It allowed us to basically not be restricted to 10 buyers. We could do single risk, but we could still choose a vertical and just whatever turnover within that vertical you could do. They could just have 2 or 3 buyers, that's still fine. There was a slight increase in indemnity, and assignment and loss PE became possible. So that's why I think the gathering address here would be probably more interested in that. Assignment, actually, as long as it's registered with the IRDAI, Section 38 of the Insurance Act, I think we can assign the policy to the bank. The bank can become a loss PE, which means really that the nominated bank can get the proceeds of the claim in the event of claim. So yeah, so basically this is where we are today, and we're hoping that that will soon open up. I think this product has massive potential to increase the overall trade credit, and also just to open up the entire economy. This is just a catalyst to increase trade in the country. So we're hoping that will come through. And with that, I think I'll wrap up. And thank you for your attention. And I made it very concise, so in case you have questions that you may have to ask, I leave the floor to you.
Hi, thanks for your interesting presentation. My name is Ramesh and I'm from Indian Bank. I want to check how are you currently operating? So are you working with the insurers as your front end, or are you working with banks directly? As what entity are you registered with the regulator as of now?
Well, good question. Basically, we are a reinsurer, but India, we are an Indian entity. We are a credit management agency. As the IRDAI, every insurer will have to have a credit CMA, basically, to provide advisory. So basically, we are in India as Traders India Credit Management Services Private Limited, which is 100% subsidiary.
Are you working like a reinsurer for most of the insurers in the back end?
Yes, we are a reinsurer on trade credit to HDFC ERGO, New India Insurance.
Hi, Mihir from Piramal. Thanks for the great presentation. You mentioned about discretionary underwriting. So a use case in my mind is for a real estate developer, where the buyers are actually the retail buyers. Yeah, you can't end up actually underwriting a buyer, but based on the discretionary underwriting, probably how do they actually sell this to the buyers is something which you can look at.
You see, when I mean the discretionary underwriting, the underwriter normally, like, we do something for the grounds up. We actually have that bandwidth and staff to actually go at the buyer level and set a limit and analyze this net worth, etc., we have agencies, etc. That's why we have full service underwriters. So discretionary underwriters, what they do is they don't have that level of bandwidth, they don't have staffing. So they go by the underlying credit management processes of the policyholder. So if you've got a decent credit management process, then they'll probably come and say, hang on, we probably give you a DCL of 50 lakhs. So all transactions before 50 lakhs and under is something that I'll be liable for, but I won't be setting a limit for that. It is incumbent upon the policyholder to set that limit. So as long as it is 50 lakhs per buyer, I'll be liable for it, but I'm not going to set that limit. I give that discretion to you to set that limit based on your credit management processes. So if you're a real estate developer, it's not a good example, but real estate is not something that we are very fond of, because in construction, as I said, it is a poor/bleak outlook. So as insurers generally don't, unless the fundamentals are very good or the buyer ratings are very good, jewelry and construction is a sector that generally is not something that we're very bullish on. But yeah, to answer your question, the insurer looks at the credit management process of the policyholder.
I'm Murli from IRDAI. What is the scenario in case the buyers are government entities?
Well, we can't, basically, because that's like underwriting solid risk. So we can't do government buyers, or we can do entities. We can do a gas authority. We can do entities in the limited, because as long as they are corporate. We can't do Department of Agriculture, because that's solid risk.
I'm not talking about a department, I'm talking about power discoms.
Power discoms, yes, we can. Yeah. As long as not a government department. As long as it's a corporation, we can.
Good evening. I am Sandeep here from Sterling & Wilson. Can you underwrite special purpose vehicles, bonus?
Not under the current guidelines. As I said, this guideline gives us only authority to look at whole turnover policies, which means that it's only on open terms and particular volume of turnover, with price based on turnover and the other details, but no one's special purpose vehicles. I don't know, this guideline doesn't really allow that. Thank you. Yeah. So if there's any other question, I'll be glad to answer this. We can always meeting over tea or whatever. So anyway, thanks so much for your attention.